Welcome to the trend section. Trend is one of the most fundamental components of trading. To understand trend, we must first understand market structure. There's two types of structures that will present trading opportunities: uptrend and downtrend. Here's an uptrend. Price forms a pattern of higher highs and higher lows. We have a low here and a high here. Price pulls back and reverses, making a higher low than the previous low. Then pushes further, creating a higher high. This swing high is higher than the previous swing high. These price moves to the upside are called impulses, and the small price moves to the downside are called pullbacks. When an impulse ends and a pullback begins, the turning points are known as swing highs. And when a pullback ends and an impulse begins, this results in the swing lows. Oftentimes, you can see previous swing highs in an uptrend form a level of support. When price pulls back into support, it will normally reverse and continue the uptrend. This is the basic market structure of an uptrend. Let's look at an example on the chart. This is our initial swing low. We have an impulse move to the upside, forming a swing high. Price then pulls back and hits this area before reversing to continue the uptrend. This created a higher low because this swing low is higher than the previous low down here. Price continues up with an impulse to the upside, breaking the previous swing high in order to form a new swing high. This is a higher high because it's higher than the previous swing high. And this is the start of a basic uptrend. We have a low, a high, a higher low, and a higher high. And as mentioned earlier, we can expect price to pull back and find support at the previous swing high before continuing the uptrend. Let's draw a level from the previous swing high further out in time. Look how price responded to it. This level acted as support. Price bounced off this level to continue the uptrend, leaving behind a new higher low, trending up to form a new swing high. Downtrend. For the downtrend, you'll see the same price movements but in reverse. Price will form a pattern of lower highs and lower lows. Here's the initial swing high. We have an impulse move down which forms our lower low. We see a pullback and price hits this turning point before reversing, creating a lower high. Because this swing high is lower than the previous swing high. Price continues to downtrend with another impulse forming a new lower low before a pullback. Now we have a high, a lower high, and a lower low. Now if we draw a level at this swing low and extend it further out in time, you'll notice that it acts as resistance when price pulls back into this level before continuing down. Swing lows in a downtrend often acts as resistance when price pulls back into them before continuing the downtrend. This is very important information because this will help you understand the concept of trend challenge. Regularly, when we're doing a top-down analysis of the charts, we might see opposing trends on different time frames, or the minor trend pushing to challenge the major trend. For example, let's say this is a daily time frame. Price is in a downtrend, but when we switch over to the 1 hour time frame, price is seemingly in an uptrend. When this 1 hour time frame approaches the previous swing low, this is known as trend challenge, because the 1 hour minor trend is now challenging the daily major trend. Our bias should always complement the major trend. In fact, the 1 hour may appear to be in an uptrend, but in actuality, it's just a pullback of the major downtrend. If this is the case, we can expect the 1 hour minor trend to continue up until the swing low, before reversing to continue the downtrend. Now that you understand uptrend, downtrend, major trend, and minor trend, let's take a look to see how we can combine all of these to create a bias. It's only useful to understand the trend if it allows us to form a bias in respect to entering a buy or sell trade. Bias. First, we open the monthly time frame for the instrument we'd like to trade. Price has been in a range for nearly 4 months. The previous month candle was bullish within the range, and this current monthly candle has respected the resistance and is now a bearish candle. Moving over to the weekly, the previous 2 weeks are bearish, and the current weekly candle has a top wick and managed to break the low of the previous candle. However, the current weekly candle is still slightly bullish with a lot of room to move to the downside of the monthly range. On the daily time frame, the major trend is bearish because this swing high is lower than the previous swing high. The current candle was bearish and the previous daily candle was bullish. The current candle respected the previous daily candle high, forming a resistance, which is strong indication that the current candle may continue down. The minor trend on the 4-hour is bearish, complementing the major trend on the daily time frame. The current 1-hour candle respected the high of the previous candle, and price is currently in a range, yet the candle is bullish. The current 30-minute candle is showing huge rejection from the upside and is bearish. The current 15-minute candle is displaying a massive bearish candle, looking ahead to the bottom of the range. From all of the information that the multiple time frames provide, we can conclude that our bias is sells. This doesn't mean that it's time to enter a trade, as bias, setups, and entries are all very different things. But this is how we use trend and multiple time frames to develop a bias for buying or selling the market. In this case, the bias is in favor of sells. We would have to utilize range to identify our setup and candle confirmation to identify our entries. That's the end of the trend section. I'll catch you in the next section, range.